Welcome everyone, have a great day. The repo rate and reverse repo rate are both monetary policy tools used by central banks, such as the Federal Reserve in the United States or the Reserve Bank of India, to regulate the money supply and manage inflation. The repo rate is the interest rate at which a central bank lends money to commercial banks against collateral such as government bonds. When the central bank wants to increase the money supply, it can lower the repo rate, which makes it cheaper for banks to borrow money and thus encourages lending and investment. Conversely, when the central bank wants to reduce the money supply, it can raise the repo rate, which makes it more expensive for banks to borrow money and thus reduces lending and investment. The reverse repo rate, on the other hand, is the interest rate at which commercial banks can lend money to the central bank and earn interest. When the central bank wants to reduce the money supply, it can increase the reverse repo rate, which makes it more attractive for banks to lend money to the central bank instead of lending to other institutions or investing in the market. This, in turn, reduces the amount of money available for lending and investment in the broader economy. In summary, the repo rate is the interest rate at which the central bank lends money to commercial banks, while the reverse repo rate is the interest rate at which commercial banks lend money to the central bank. Both rates are important tools for regulating the money supply and managing inflation.